In this video, we're going to break down two of the most important concepts in smart money trading: order blocks and breaker blocks. Step by step, you'll learn how institutional supply and demand zones form, how to identify high-probability trading opportunities, and how to recognize when a valid order block is likely to continue the trend or transform into a breaker block. By the end of this lesson, you'll understand how market structure, liquidity, fair value gaps, order blocks, and breaker blocks work together as part of a complete trading framework, giving you a clearer and more structured approach to analyzing and executing trades in any market. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin with the basics. What exactly is an order block? Order blocks are essentially refined or optimized supply and demand areas. From basic price action theory, we know that the market always moves in a rhythm of impulsive and corrective waves, shaped by the collective behavior of market participants. We identify the starting point of an impulse as a demand zone. This happens because in that area, traders have previously entered long positions with a clear intention. When price returns to the same demand zone, there is a higher probability that those traders, or new ones recognizing the opportunity, will start buying again. Simply put, demand zones highlight areas where we expect buyers to step back into the market. Likewise, the beginning of a downward move is identified as a supply zone, where traders have previously taken short positions. When price revisits this zone, it often leads to renewed selling pressure. In other words, supply zones are areas where we expect sellers to become active once again. Now, order blocks are a special type of supply and demand zone, but they form when a large number of buyers or sellers enter the market at once, creating a visible imbalance in price. This imbalance between buying and selling pressure can often be identified through what we call fair value gaps. These gaps appear when price moves too quickly in one direction, leaving certain orders unfilled, and the market may later return to those areas to restore balance. We usually mark the candle that appears right before the gap as our order block zone, because that is where major trading decisions were likely made. When price comes back to this order block, we often see a strong reaction as institutional buyers or sellers re-enter the market. So in essence, order blocks are still supply and demand zones, but the key difference is that we focus specifically on areas where larger institutional orders were placed, revealing where the real smart money operates within the market. Now, how do we actually mark the order blocks? We take the entire candle that appears right before the fair value gap and mark it as our order block. The color of this candle doesn't matter at all. For example, in a bullish gap, it makes no difference whether the candle is green, red, or even a doji with a very small body. All of them can represent valid demand order blocks. Here's an important point to remember. Sometimes, the wick of a candle grabs liquidity just before the imbalance occurs. When that happens, we also include that wick as part of the order block zone. This marks the true beginning of the imbalance. And for safety, our stop loss should always be placed just below that wick to protect the trade. Order blocks can vary in size. Some are small, while others can be quite large. When the zone is narrow, it's wise to use a slightly wider stop loss below it, because even though order blocks represent strong supply and demand areas, price does not always reverse exactly from the box. We need to give the market a little space to breathe before expecting a reaction. On the other hand, when the order block is large, you can place your entry closer to the middle of the zone to get a better price, or switch to a lower time frame to look for confirmation and rejection signals before entering. Now, what makes an order block high quality and worth trading? The answer lies in its alignment with the overall market structure. In an uptrend, price forms a sequence of higher highs and higher lows. Each time price breaks structure to the upside, it confirms the continuation of the bullish trend. The bullish order blocks formed along the way have a higher probability of rejecting price back to the upside if the market pulls back into them. This uptrend continues until the market eventually breaks below a protected low. That event is called a change of character, and it signals a potential trend reversal. It shows that sellers have gained control and managed to push the price lower. The bearish order block responsible for that move becomes a strong opportunity to go short. From that point forward, if the trend begins forming lower lows and lower highs, the bearish order blocks that appear along the way also become reliable trading setups. Of course, the concept of market structure goes much deeper than this, but for now, this explanation gives you a clear and practical foundation for understanding how order blocks form, how to identify them, and how to use them effectively within your trading strategy. Now that we've explained order blocks and market structure, it's time to move on to the actual trading strategy. This strategy operates using 2 time frames, and we've simplified it into 5 clear steps. First, analyze the market structure on the higher time frame to determine the overall direction. Second, mark the key order blocks. Third, wait for price to pull back toward those zones. Fourth, look for a change of character on the lower time frame to confirm the reversal. And finally, execute your entry from the order blocks on that lower time frame. As mentioned earlier, this setup always relies on 2 different time frames. The higher one serves as your main chart for day trading analysis, and the lower one is used for confirmation, precise entries, and managing your active trades. It doesn't matter exactly which time frames you prefer to use. The important rule is that your entry time frame should be at least 2 times lower than your higher time frame. For example, many traders combine the 1-hour chart with the 15-minute chart, or the 4-hour with the 1-hour, depending on their trading style. The next important point is that this strategy can be applied to any market or asset class. It makes no difference whether you trade Forex, crypto, indices, or stocks, because price action principles remain consistent across all charts. Still, make sure to backtest thoroughly before trading with real money, so you can see how the strategy behaves under different market conditions. Now let's return to analyzing the market structure, which is the foundation of this plan. The very first step is to identify the market direction. Trading in alignment with the main trend almost always gives you a higher probability of success. To determine that direction, look for clear breaks of structure, changes of character, and recognizable reversal patterns on your chart. If you can't clearly see the direction on a specific time frame, it's better to skip that setup entirely. Trading when the market direction is uncertain only increases your risk. It's much safer and more effective to focus on instruments or pairs that show a clean, obvious trend. This allows for better decision-making and more consistent risk management. Next, we identify the fair value gaps and mark the order blocks, which serve as our main trading zones. At this stage, we can simply place a sell limit order at the order block and position our stop loss just above it. However, for a more conservative approach, it's often better to zoom into lower time frames once price reaches this area. That way, we can observe how the market reacts around the zone and confirm whether the trade setup is truly valid. We want to see a clear rejection from the order block to ensure that it is being respected. Even though this setup has a high probability, price does not always reverse perfectly from the box. The market can easily ignore an order block, so patience and confirmation are key. The next step is to wait for price to pull back into the order block zone, and then drop down to a lower time frame for closer analysis. Remember, never jump into the market before price actually reaches your zone. Many traders get trapped by entering too early, right before the market delivers the real move. Now, in the final step of this trading plan, we look for confirmation signals and execute the trade on the lower time frame. After price enters our zone, we need evidence that the short-term uptrend has ended and that the market is preparing to move lower. To identify this reversal, we look for a change of character. This occurs when price breaks below a recent swing low, confirming that the short-term uptrend is over and that momentum is now shifting downward, in alignment with the bearish direction from the higher time frame. Once this reversal is confirmed, we wait for the market to form new bearish order blocks on the lower time frame, and then take the trade. This is why the method is known as order block within order block. It's important to note that the lower time frame order block does not always need to be fully contained inside the higher time frame order block zone. After identifying the lower time frame order block, we place a sell limit at the start of that zone and set our stop loss just above it for protection. For trade management, we aim for multiple targets. The first target is usually a 1-to-2 risk-to-reward ratio. Once price reaches this level, we close half of the position and move the stop loss to break even. The next target is typically the first significant support or liquidity zone ahead of price on the higher time frame chart. Here's a quick recap for the bullish scenario. The same rules apply, but in reverse. We wait for price to reach our higher time frame order block. Then, we look for a change of character on the lower time frame, which occurs when price breaks above a swing high. This confirms that the short-term downtrend has ended and that buyers are now taking control of the market. Once this is confirmed, we look for new bullish order blocks forming on the lower time frame and place a buy limit order at the beginning of the zone, with the stop loss positioned just below it. Targets are managed in the exact same way as in the bearish setup, following a structured risk-to-reward approach. Now, before we move on to real chart examples, let's quickly review a few common scenarios and how to handle each one effectively. Scenario 1. A very small order block on the lower time frame. In this case, it's safer to use a slightly wider stop-loss area to protect your trade from normal price fluctuations. A stop that's too tight can easily be triggered by minor volatility, even if the setup is still valid. Scenario 2. A very large order block on the lower time frame. If we place our stop loss below the entire zone, it might become too wide and weaken our risk-to-reward ratio. Instead, we can either define a smaller protective zone just below the main block, or place our entry closer to the middle of the zone. Both methods help maintain a balanced and efficient trade setup. Scenario 3. Multiple order block formations. We can trade each one as long as they provide a reasonable risk-to-reward opportunity. However, it's essential to manage risk carefully. Never risk more than 2% of your trading account on a single position, and avoid having more than 3 trades open simultaneously. This discipline keeps you capital protected, even during losing streaks. Finally, always remember this: the goal is not to win every single trade. Losing trades, missed setups, and small drawdowns are all normal parts of trading. What truly matters is maintaining consistency, managing risk wisely, and finishing the day with a positive overall result. Now, let's look at some real chart examples to see exactly how to apply this trading plan in practice. Here we have the euro-dollar on the 1-hour chart. The recent price action shows that the market had been in a clear long-term downtrend until it suddenly shifted direction by breaking above this protected low. That break of structure represents a change of character, signaling that demand has taken control and that a potential bullish reversal, or the beginning of a new uptrend, may be underway. Since the higher time frame direction is now bullish, we're only interested in looking for buying opportunities. The next step is simple. Identify the fair value gaps and mark the order blocks. In this example, we can see two distinct fair value gaps, so we mark the candles that created those gaps as our order block zones. These areas become our key trading zones for potential entries. If the price pulls back into any of these zones, we'll then zoom into the lower time frames to look for confirmation signals before taking a trade. So let's see how this plays out. The price has just tapped into the first order block, so we switch to the 5-minute chart to search for an entry. On this lower time frame, we want to see clear signs of reversal, confirmation that the order block is being respected, before opening a long position. For confirmation, we look for a change of character on this lower time frame. This happens when price breaks above the swing highs that led to the previous downward move. Let's play the price forward. Here, we can see that price actually broke below the order block without showing a clear change of character. Although there was a brief reaction to the zone, it failed to confirm the reversal we were looking for, meaning there's no valid trade setup at this point. Now let's go back to the 1-hour chart. On this chart, we still have another unmitigated order block zone below. If the price moves down into this area, we'll once again switch to the lower time frame to look for a precise entry signal. Let's see how the price develops next. The price has now tapped into this order block, so we zoom into the 5-minute chart again. On the 5-minute chart, the market has already shown a clear change of character. Exactly the reversal signal we were waiting for. This tells us the short-term downtrend has ended, and we can now start looking for long setups with confidence. The next step is to wait for price to form bullish order blocks, and then use them as entry points. Here, the market creates its first bullish order block, so we open a long position. As price continues to push higher, another order block forms, but this time without invalidating the previous setup. We open a second long trade based on this new formation. This approach is important because the pullback to the very first order block doesn't always happen. Sometimes the market only returns to the second one before continuing higher. In the worst case scenario, the price could drop deeper and hit both stop losses. And that's why we always trade with reduced risk. Now, let's see what happens next. The price hits the stop loss of the second trade, but keeps moving higher, triggering the first one. A bit later, another order block appears. Once again, without closing the first trade, we take a new long position at this fresh order block zone. We continue repeating this process until the market reaches our target. In this example, the previous high on the higher time frame. Now, there is one important question we still need to answer. What happens when an order block fails? Throughout this lesson, we focused on situations where price respects the order block and continues moving in the expected direction. However, the market does not always behave that way. Sometimes, price breaks directly through the order block, shifts market structure, and completely changes its directional bias. Many traders assume that once an order block fails, it becomes irrelevant. But in reality, a failed order block can often become one of the most powerful trading zones on the chart. In fact, these failed order blocks create a completely different type of setup that institutional traders use to identify high-probability reversals and continuation opportunities. This is where breaker blocks come into play. So, what is the definition of a breaker block? A breaker block is a previously failed order block that transforms into a key supply or demand zone on the price chart. This happens when an order block is broken in the opposite direction, shifting its role from supply to demand or from demand to supply. In practice, a breaker block helps mitigate positions and often becomes an area where traders add to their positions. There is also an important principle to keep in mind. Whenever price breaks through a key demand or supply zone without showing respect, that zone automatically shifts its characteristic. A supply zone becomes demand, and a demand zone becomes supply. The same principle applies to order blocks. The market may ignore the supply or demand of an order block for several reasons, such as shifts in market structure, overvalued or oversold conditions, interaction with higher time frame key areas, major economic news releases, or other fundamental drivers. When a valid demand order block fails to reject the price and the market breaks through it to the downside, it turns into a supply level known as a breaker block. In this situation, we expect the price to reject that zone and continue pushing lower. Now, let us look at the psychology behind the breaker block and understand how it works. Imagine a bullish break of structure forming above the last high with inefficiency. This movement creates a valid order block tied to that break of structure, giving traders a reason to look for long entries. However, if the price later shifts market structure by pushing and closing below the most recent low, the directional bias flips to bearish. When this happens, the original demand level loses its strength and turns into a supply level as the price breaks through the order block to the downside. The psychology behind the breaker block is straightforward. Traders who went long from the original order block now find themselves trapped. They wait for price to return to break even so they can exit without taking a loss. When many long positions close in the same zone, a surge of sell orders enters the market, creating strong downward momentum. At the same time, retail traders often see the previous structure shift as a trend line breakout. They expect the price to pull back for confirmation, which leads them to look for short setups at the retest area, also known as the breaker block. Many traders will short this zone because they view it as a key supply area. Combined, these actions turn the breaker block into a clearly defined supply zone with a high probability of generating short opportunities and driving price reversals. One more point to note is that breaker blocks tend to be most effective when the market is trending strongly in either direction with shallow pullbacks, and when price is not respecting premium or discount supply and demand levels along the way. Now let us move to the next topic and look at how breaker blocks are identified from a candlestick perspective. In a bullish scenario, a candlestick-based breaker block appears when an area fails to reject the price. This is represented by the last selling candle that forms just before a strong upside move. That candle usually breaks below or sweeps the liquidity of the lowest point of the previous candle. In a bullish diagram, we would highlight this red candle as the breaker block because it is the final bearish candle before price launches into a sharp upward movement after sweeping the previous low. A similar idea applies in the second candle sequence. Here, the breaker block is the last small bullish candle that forms right before another sharp upside move, breaking below or sweeping the liquidity of the previous candle's low. These same principles hold true in bearish markets as well. It is also important to remember that these concepts work across different time frames and on any price action-based chart. Make sure to follow the video closely until the end. In the next section, we will explore the criteria and rules for identifying valid breaker blocks and review the scenarios that turn a breaker block into a high probability entry area for strong trading setups. To identify valid breaker blocks and use them effectively, we need to consider several criteria and rules. The first point is the clearing of buy-side or sell-side liquidity. For a breaker block to be valid, the price must take out a clear area of liquidity before forming a market structure shift. Here is an important pro tip. When identifying a valid order block, the price must break and close above or below the recent swing high or low to confirm a proper break of structure. However, this condition does not apply to breaker blocks. When identifying a breaker block, the candle body does not need to close above or below the recent swing point. The second rule states that in a bullish scenario, the sharp movement should create a higher high, and in a bearish scenario, it should create a lower low. This helps filter out isolated candle spikes and avoids relying on manipulated or emotionally driven moves before a market structure shift forms. The third rule highlights that once buy-side or sell-side liquidity has been taken out, the price must begin to reverse its direction. The fourth rule states that a breaker block is only considered valid if the price breaks and closes below or above the breaker block with the body of the candle. A simple penetration with a shadow or wick is not sufficient. Rule number 5 explains that breaker blocks are treated as one-time use zones. This means we focus on the trading opportunity when the price first returns to the breaker block. Once the area has been mitigated, it is no longer considered an active zone for future setups. To integrate all the criteria and rules for identifying valid breaker blocks, let us review a clear chart example. First, we have a swing high followed by a swing low. Then we see a strong upward push that breaks and closes above the previous swing high. This movement establishes a valid order block, showing strong demand. Once the buy-side liquidity is cleared, the market quickly reverses direction after forming a new higher high and begins to push downward. Eventually, the price breaks and closes below the low of the last bearish candle, confirming a clear shift in market structure. At this point, the zone becomes a valid bearish breaker block, indicating that buyers positioned in this area have been stopped out. Since the market has shown a bearish structure shift and a former demand zone has now turned into supply, we expect the price to reject this breaker block and continue moving downward. As shown, the price first pulls back upward and pauses briefly inside the breaker block. After building up additional buy orders, it gains momentum and resumes its move to the downside. Moving forward, the first high-quality type of breaker block with strong probability occurs when it forms immediately after a liquidity sweep. As mentioned earlier, a liquidity sweep is created by a single candle that clears liquidity above or below a previous high or low. This pattern often appears right before a sharp and meaningful reversal. In this situation, we anticipate a quick price reversal following the sweep. Once liquidity is cleared, the price typically returns to the area of the most recent swing low or swing high. A liquidity sweep is recognized by a candle with a long wick or body, followed by a sharp and immediate price movement that triggers a market structure shift. Looking more closely, we can see that the price has created a valid, unmitigated breaker block exactly at the location of the last buying candle. This candle formed right before a strong downward move. This breaker block meets all the criteria of an ideal setup. The price cleared sell-side liquidity, and after forming a new lower low, quickly reversed and created a market structure shift by breaking and closing above it. At this point, we can identify a valid breaker block positioned above the fair value gap. Placing an entry directly at the fair value gap might cause a missed opportunity, since the price often does not return to the gap once it moves decisively away from it. In this case, the reaction is expected to come from the breaker block rather than the fair value gap. For this reason, the entry should be placed at the highest point of the breaker block, with a stop loss positioned a few pips below the fair value gap. When planning the execution, there are two main options. The first is a single time frame entry taken directly from the current chart. The second is a more conservative approach that waits for additional confirmation. This could include looking for multiple reversal signals, such as a change of character forming on lower time frames inside the breaker block that was identified on the higher time frame. A second high-quality setup happens when a breaker block aligns with a significant liquidity void. This usually occurs when the price breaks through the breaker block with inefficiency, leaving the entire area inside a gap. This combination often produces highly reliable buy or sell opportunities. Another strong setup appears when a breaker block forms in conjunction with an order block. In this case, the order block develops near the breaker block zone. These setups are powerful because they mark areas where many orders were previously executed and where positions may still be active, increasing the probability of a retest. In this final scenario, we identify a valid breaker block paired with an order block. The entry is placed at the highest point of the breaker block, and we wait patiently for price to return and activate the trade. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Comlucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Comlucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.